What if the biggest financial mistake many Americans over 65 are making has nothing to do with investing, inflation, or the stock market? What if thousands of dollars are quietly leaving their pockets every single year because of benefits, exemptions, and deductions they already qualify for, but never claimed? The surprising part is that nobody is required to warn you. No government agency calls you. No county office sends a reminder. No one shows up at your door and says, "You've been paying bills you may not owe anymore." The money simply keeps leaving your account month after month, year after year, while most people assume everything is correct. That is what makes this issue so important. The moment you reached age 65, a number of financial rules began applying to you differently. Many people know that Medicare eligibility starts around this stage of life. What they do not realize is that age can also unlock additional tax deductions, property tax relief programs, healthcare assistance opportunities, and other benefits that can reduce ongoing expenses. The challenge is that qualifying for something and actually receiving it are often two very different things. Millions of retirees spend years carefully managing their budgets. They compare grocery prices, delay purchases, and look for ways to stretch every dollar. At the same time, some of those same individuals may be overlooking programs that could potentially save them hundreds or even thousands of dollars annually, not because they are careless, not because they failed to plan, simply because nobody ever explained what questions to ask or which forms might need to be filed. Before we continue, there is one common misconception that needs to be addressed. Many people assume that programs designed for seniors only help low-income households. Others assume the exact opposite and believe the benefits are mainly useful for wealthier retirees with expensive advisors and accountants. In reality, both assumptions can be wrong. Some benefits provide the greatest value to people living primarily on Social Security. Others can be especially valuable for homeowners whose properties have increased significantly in value over the years. Some programs help reduce healthcare expenses. Others focus on taxes. The key point is that age-related opportunities exist across a wide range of financial situations. That is why understanding these programs matters regardless of whether you consider yourself wealthy, middle class, or financially constrained. One of the most significant developments involves additional tax deductions available to older Americans. Tax deductions do not always generate excitement. The topic sounds technical, and many people tune out the moment taxes are mentioned. But when a deduction reduces the amount of income subject to taxation, the impact can be meaningful. Recent tax provisions have created additional opportunities for qualifying seniors to reduce taxable income. For many retirees, this means the amount of income exposed to federal taxation may be lower than they expect. Yet countless taxpayers never verify whether every age-related deduction was properly applied to their return. Think about how most tax returns are completed. Some people use software. Others work with paid preparers. Some rely on volunteers. Many simply sign where instructed and assume everything was handled correctly. Most of the time, that approach works reasonably well. But assumptions can become expensive when a deduction is overlooked. A missing deduction does not trigger a warning siren. The IRS does not automatically contact you and ask whether you intended to claim it. The return gets processed. The tax gets paid. And unless someone notices the mistake, the opportunity disappears. That is why reviewing your return carefully remains important even when someone else prepares it. A few minutes spent verifying age-related deductions can sometimes make a noticeable difference. The next area deserves even more attention because the potential savings can be substantial. Property taxes. For many retirees, property taxes become one of the largest recurring expenses they face after paying off a mortgage. While mortgage payments eventually end, property taxes generally continue. As home values increase, those taxes can rise as well. What many homeowners do not realize is that various states and local governments offer programs designed specifically for owner-occupied primary residences and older homeowners. The first category often involves homestead exemptions. While details vary by location, these programs typically reduce the taxable value of a qualifying primary residence before the tax bill is calculated. A lower taxable value can mean a lower property tax bill, yet many people mistakenly assume these exemptions are applied automatically. In some areas, they are not. A homeowner may need to complete an application before receiving the benefit. Missing that step can result in paying more than necessary year after year. Then there are senior-specific property tax programs. Again, Rules differ depending on location, but many jurisdictions provide additional relief once homeowners reach a certain age. Some programs reduce taxable value further. Others limit future increases. Some create specialized protections designed to help seniors remain in their homes despite rising property values. The reason these programs matter has become increasingly obvious over the last several years. Home prices have climbed dramatically in many communities. A house purchased decades ago may now be worth several times its original value. While that appreciation may look positive on paper, it can also contribute to larger tax assessments. For retirees living on fixed incomes, rising property taxes can become a serious concern. This is where another powerful tool sometimes enters the picture: assessment freezes or tax ceilings. Although availability varies by state and locality, these programs may limit how much a property's taxable value or tax bill can increase after eligibility requirements are met. The long-term impact can be enormous. Imagine two homeowners living in similar houses. One successfully enrolls in a qualifying protection program. The other never files the paperwork. Over time, as property values rise, the difference between their tax obligations may become significant. What makes this particularly frustrating is that the opportunity often existed all along. The only difference was awareness. That is why homeowners should periodically contact local assessment offices and ask what programs may be available based on age and residency status. A simple conversation can uncover opportunities that otherwise remain hidden. Healthcare costs represent another area where many retirees unknowingly leave money on the table. Most Medicare beneficiaries are familiar with monthly premiums because those amounts are frequently deducted automatically. When deductions occur behind the scenes, people sometimes stop thinking about them altogether. The money disappears before it reaches their bank account. As a result, they rarely question whether assistance programs exist. But for qualifying individuals, programs designed to help cover Medicare-related costs may be available. These programs can assist with premiums and, in some situations, other healthcare expenses as well. The surprising part is how many eligible individuals never apply. Sometimes they assume their income is too high. Sometimes they believe their savings automatically disqualify them. Sometimes they simply have never heard of the programs. As a result, assistance goes unclaimed. This is unfortunate because healthcare expenses often represent a major portion of retirement budgets. Even modest reductions can create meaningful financial breathing room over time. Consider what happens when a recurring monthly expense disappears. 1 month may not seem life-changing, but 12 months become a year. Several years become thousands of dollars. That is real money that can be used for groceries, utilities, transportation, home repairs, or emergency savings. And healthcare assistance is not limited solely to Medicare premiums. Prescription drug costs can also create financial strain. Many retirees take multiple medications every month. Even relatively small copayments add up over time. Programs exist that may help reduce certain prescription-related expenses for qualifying beneficiaries. Yet once again, awareness becomes the obstacle. People cannot apply for assistance they do not know exists. That is why education matters. The goal is not to encourage dependence. The goal is to ensure people understand the options legally available to them. After all, many of these programs were created specifically to assist older Americans facing rising costs. There is nothing improper about exploring benefits that were designed for eligible individuals. In fact, failing to understand available resources may place unnecessary pressure on retirement finances. Another overlooked reality is that financial relief rarely comes from one giant source. More often, it comes from multiple smaller savings working together. A reduced tax bill here, a property tax reduction there, a healthcare savings program, a prescription assistance benefit, an additional deduction. Individually, some of these may seem modest. Combined, they can become meaningful. That is why retirees should evaluate their finances as a complete system rather than focusing on a single expense. Many people search for one dramatic solution while ignoring several practical opportunities sitting right in front of them. The most effective financial improvements often happen gradually, a few $100s saved in one area, a few hundred more in another, then additional savings from a program that had been overlooked for years. Eventually, those changes begin to add up, and that leads directly into one of the most valuable areas of all, making sure you are not paying more federal tax than necessary and understanding how multiple senior-focused provisions can work together to reduce overall tax liability. The reality is that many retirees spend years worrying about market fluctuations, interest rates, and inflation while overlooking something much closer to home, money they may already be entitled to keep. In many cases, the issue is not earning more, it is stopping unnecessary losses. Every dollar that remains in your pocket is a dollar that does not need to be replaced through additional income, investment returns, or withdrawals from retirement savings. One of the most common examples involves withholding. Many people continue using the same withholding settings they established years ago, even though their financial situation has changed dramatically. During working years, withholding decisions often reflected employment income, career growth, and changing tax obligations. Retirement can be completely different. Income sources change, deductions change, tax brackets may change, additional age-related provisions may become available. Yet countless retirees continue having taxes withheld at levels that no longer reflect reality. The result is surprisingly common. People end up sending more money to the government throughout the year than necessary, only to receive a refund months later. Some view large refunds as positive because it feels like receiving extra money, but in reality, that money already belonged to them. It simply remained unavailable for months. For retirees managing fixed incomes, having access to those funds throughout the year can often be more useful than waiting for a refund check. This does not mean everyone should reduce withholding. The correct approach depends on individual circumstances. The important point is that retirement is an excellent time to review existing withholding arrangements and determine whether they still make sense. Another overlooked opportunity involves programs designed to help with everyday living expenses. These programs rarely attract headlines. They are not glamorous. They do not generate excitement. Yet they can provide meaningful support over time. Communication services are one example. In today's world, phone and internet access are not luxuries for many older adults. They are necessities. Medical appointments, family communication, banking, benefit management, healthcare information, and emergency services increasingly depend on reliable access to communication tools. Certain assistance programs exist specifically to help qualifying households reduce these costs. The monthly savings may not appear dramatic at first glance, but recurring savings accumulate. 12 months become years. Years become thousands of dollars. The same principle applies to energy assistance programs. Heating and cooling costs can place significant pressure on household budgets, particularly during periods of extreme weather. For retirees living on limited incomes, utility bills can become a major source of stress. Assistance programs designed to address these challenges may be available depending on location and eligibility requirements. The larger lesson is that financial stability is often strengthened through multiple improvements working together. There is rarely one magic solution. Instead, successful retirement planning typically involves identifying every available advantage and making sure none are overlooked. This brings us to an important question. Why do so many people miss these opportunities? The answer is surprisingly simple. Most benefit systems are passive. They do not aggressively seek out eligible participants. They wait for individuals to apply. Think about it from the perspective of an average retiree. They are managing healthcare appointments. They are helping family members. They are maintaining a home. They are dealing with everyday responsibilities. Researching exemptions, deductions, and assistance programs often falls to the bottom of the priority list. As a result, years pass. Benefits remain unclaimed. Money continues flowing out unnecessarily. And because the losses occur gradually, many people never recognize the problem. There is no warning light, no emergency notification, no monthly statement highlighting what could have been saved. The absence of a benefit rarely feels as obvious as receiving a bill. Bills demand attention. Missed opportunities usually remain invisible. That is exactly why awareness is so valuable. Sometimes a single conversation reveals opportunities that have existed for years. A simple question asked at the right office, a quick review of tax documents, a call to a healthcare assistance organization. Small actions can create surprisingly large results. There is another category of opportunities that often receives very little attention: protections available to surviving spouses. The period following the loss of a spouse is one of the most difficult transitions many people ever face. Financial decisions are rarely the first thing on someone's mind. Unfortunately, administrative deadlines and filing requirements do not always pause during periods of grief. As a result, valuable protections can occasionally be overlooked. Depending on state and local regulations, certain exemptions, tax benefits, or property-related protections may require action after the death of a spouse. Failing to understand available options can sometimes result in higher expenses precisely when households are already facing emotional and financial challenges. This is one reason estate planning professionals frequently emphasize periodic reviews. The goal is not simply preparing documents. The goal is understanding how various protections work before they become urgently needed. Vehicle-related fees provide another example of a benefit category many people never investigate. In some locations, age-based discounts or exemptions may apply to registration fees, excise taxes, or other recurring vehicle expenses. Individually, these savings may appear modest, but once again, recurring costs matter. Most retirees understand the value of reducing recurring expenses because recurring expenses never stop. A one-time purchase eventually ends. Monthly costs continue indefinitely. Reducing those costs creates ongoing benefits. The broader pattern should be becoming clear by now. Financial success during retirement is not always about finding new sources of income. Sometimes it is about ensuring existing rules work in your favor. Sometimes it is about claiming benefits you already earned. Sometimes it is about understanding opportunities that have been available all along. This perspective changes the conversation. Instead of constantly asking, "How can I earn more?" the question becomes, "Am I keeping everything I am legally entitled to keep?" That question alone can uncover opportunities many people miss. Consider the story of a typical retiree, not someone wealthy, not someone struggling dramatically, just an ordinary homeowner who worked hard, paid taxes, raised a family, and eventually entered retirement expecting life to become a little simpler. Over the years, property values increased, healthcare costs rose, tax rules changed, new programs became available, old programs were modified. Yet the retiree continued doing things exactly as before because no one explained that anything had changed. The result? Higher expenses than necessary, missed deductions, unclaimed assistance, and a growing belief that rising costs were simply unavoidable. Then one day they review their situation, they ask questions, they verify exemptions, they check healthcare assistance eligibility, they examine their tax return more carefully. Suddenly, several opportunities appear. Nothing about their life changes dramatically. They do not move. They do not win the lottery. They do not discover a secret investment strategy. They simply begin using benefits and protections that were already available. The monthly budget improves. Financial stress decreases. Confidence increases. That is the power of awareness. The purpose of discussions like this is not to promise extraordinary outcomes. Not everyone will qualify for every program. Not every exemption applies in every state. Not every deduction fits every financial situation. But almost everyone benefits from understanding what questions to ask. That knowledge creates options, and options are valuable. Before we finish, here is a practical action plan. First, review your most recent tax return and confirm that all age-related deductions and adjustments were properly applied. Second, contact your local property assessment office and ask whether any homeowner, senior, homestead, or tax limitation programs are available. Third, review healthcare-related assistance opportunities that may help with Medicare or prescription costs. Fourth, examine recurring expenses such as utilities, communication services, and local fees to determine whether age-related discounts or assistance programs exist. Finally, keep records organized and revisit these areas periodically because eligibility rules can change over time. The most expensive mistake is assuming that because you qualified for something once, everything will automatically remain correct forever. Regular reviews help prevent that problem. Remember, the goal is not complexity. The goal is simplicity. The goal is ensuring that retirement resources last as long as possible. The goal is reducing unnecessary expenses. And the goal is keeping more of the money you worked so hard to earn. Many people spend decades building financial security. Protecting that security requires more than saving and investing. It also requires understanding the rules that apply during retirement. The good news is that awareness costs nothing. A phone call costs nothing. Asking questions costs nothing. Reviewing paperwork costs nothing. Yet those simple actions can sometimes produce meaningful financial benefits. If there is one message to take away from today's discussion, it is this. Never assume someone else is monitoring every benefit, exemption, deduction, or protection available to you. The responsibility ultimately belongs to the individual. The people who benefit most from these opportunities are often not the smartest, wealthiest, or most connected. They are simply the people who take the time to learn what is available and then act on that information. Retirement should be about enjoying the results of decades of hard work, not unknowingly paying expenses that could have been reduced. The more informed you become, the better positioned you are to protect your finances, support your family, and maintain greater peace of mind in the years ahead. USA Benefit Advisor.